When it comes to investing in today's real estate market, there are just so many options in terms of all the houses, retail properties, and even locations that you could purchase for business. But you might be wondering, how exactly can you make money without actually buying a property, but still being part of the real estate market itself? Well, the answer to that is investing into REITs. REITs are real estate investment trusts, which manage or own income-producing commercial properties, whether it's in the properties themselves or the mortgages of those properties. You can invest in these companies through an exchange-traded fund, or you could just do it with a mutual fund. Best part about this is you can invest in all types of REITs because there are multiple categories. So in this video, I'll be breaking down exactly what a REIT is, exactly how you could invest into it, and all the types of REITs that there are that you could put your money into starting today to be considered a real estate investor without owning any properties. Keep in mind that none of this is financial advice, and I'm just a random dude on YouTube who you came across. So please do your own research if you do want to learn more on these topics the safe way. But the information that I will be sharing is information that I found online and that I've also learned. First off, you can't go investing into anything without having any historical context on its returns. And the best part about this is REITs return a beautiful average of around 9.5% since 2010 going into 2020. They're actually one of the best performing assets in today's market. More recently, however, REITs have been averaging 11.25% yearly since 2017 going on to 2020. And this 11.25% return has actually outperformed the S&P 500. Now that you've got an idea of what a REIT is and how it's actually returned in the previous years, let's go over exactly what types of REITs there are that you could invest in today. The first and one of the most popular REIT options is actually a retail REIT. It turns out that 24% of all REIT investments are actually retail REITs, which include shopping malls and shopping plazas. And also there are freestanding retails. If you go shopping frequently, then you've probably gone into a building that's owned by a retail REIT company. The best thing to do when going into retail REITs is actually determining how valuable and how successful the retail industry in that area is. You have to ask yourself, is this company doing good financially, and is the future looking successful for it? These retail REITs mainly make money off of the rent that they charge the tenants. If the tenant is having a hard time generating cash flow with their business, that means they're not going to make their payments on time, which is going to affect the REIT itself. Which is why you need to do prior research on the industry and company that you're putting your money into and see how all the retail investors are doing in those areas. And it's never easy to find a new tenant, so you want to make sure that the tenant that's already there is actually doing pretty well for themselves, because it's not going to be easy for the REIT to just replace them if they're struggling. Two of the best areas in retail REITs to invest in is normally grocery stores and home improvement stores, because these tend to have the strongest foundation. Next up, we have residential REITs. Residential REITs is pretty much something that you're probably part of right now, because a lot of times this REIT owns homes that a lot of people rent. They normally own and operate multi-family apartment buildings. Now, when it comes to investing in a retail REIT, you also want to look at how high the demand in the area is and see how much people are paying for rent in those areas. Usually in large cities such as New York, Los Angeles, and Miami, you have tenants paying a large amount of rent, which means the landlords could charge a whole lot more. So in this process, the REITs are able to generate a lot more income, so they tend to focus in those areas. So you should too. In urban centers, there's usually a lot more job growth and population growth, which means that the economy over there is definitely booming. When it comes to these REITs, you want to see that the apartment buildings are constantly being filled up and that there's a high demand and a lot more people looking to find more room, but there's a shortage of rooms, because that means that the demand is extremely high and the potential for profits is extremely good for these REITs. Supply and demand will be your best friend in this category for sure. Next up, we have healthcare REITs, which invest in hospitals, medical centers, nursing facilities, and retirement homes. When it comes to this REIT, their success is highly determined by the healthcare system. These facilities really rely on occupancy fees and Medicare and Medicaid reimbursements, as well as private pay. You want to make sure that when investing into these healthcare REITs that they have a diversified group of people. And you also want to make sure that they're highly diversified in different property types for the healthcare facilities. Also take a look at their balance sheets to make sure that they're actually generating the income they say they are. And you want to make sure they have a strong foundation with the type of services they're providing. Next up, another REIT that you could invest into is an office REIT. And just like its name says, office REITs own office buildings. They normally receive rental income from the tenants who stay there, and usually these tenants have a long lease contract signed with these REITs. There really isn't too much to it, because you just have to look at the fact that the tenants have to pay on time, and once they have a lease, they're required to make their payments and remain constant. But at the same time, you want to make sure that the office buildings that this REIT is invested into is a strong foundation, which is reliable and in a busy part of the city. Because as we discussed before, supply and demand will play a huge factor in how consistent the tenants are and how easy they are to replace in the case that they cannot make their payments. Last but not least, we have mortgage REITs. And approximately 10% of REITs have to do with mortgages. Now, just because this REIT is mainly focused on mortgage does not mean it does not have risk associated with it. An increase in interest rates would translate into a decrease in the book value of the mortgage REITs itself, which in turn will drive the stock prices a whole lot lower. Mortgage REITs also get a considerable amount of their income from secured and unsecured debt offerings. Now, if interest rates were to rise, that just means that it'll be a lot more expensive for the people looking to make a mortgage payment on their homes, which would reduce the value of a portfolio of loans. In a low interest environment, when everything is booming and there seems to be a higher demand of rising rates, most mortgage REITs trade at a discount to net asset value for each one of their shares. Really, what you have to do is try to find the right one. So when it comes to REITs overall and investing in any sector of REITs, you have to make sure to do extreme research and look at balance sheets when it comes to each one of those areas. Whether it be in healthcare, retail, or any other department, you have to make sure that you're looking to see how reliable that foundation is and how consistent they look for the future, because future success is what determines your future rates. So if you expect to make an 11.25% return, you have to make sure that what you're investing in seems as secure as that return you're expecting. Overall, there is a whole lot to know about REITs, but it is a great foundation to put your money into because it's actually extremely reliable in terms of looking out for the future. Everybody's going to need a place to stay, and businesses are always going to come up consistently. And if you go to the hospital or need a constant medical checkup, that means that there is a REIT benefiting from that. So you want to make sure that you're looking into those categories and putting your money in the best place possible. Although it might seem complicated, the constant returns will be worth it because it's definitely one of the more reliable sectors to put your money into. Overall, I hope you guys did enjoy this video, and if you guys do have any other suggestions for a future video, please be sure to drop a comment down in the comment section below and I'll take a look at it when I get the chance. And if anything, if the topic is actually extremely interesting, I will make a future video on it. Other than that, please be sure to subscribe to the channel, smash that like button, and turn on post notifications as it truly helps the channel out. I hope you guys have a great rest of your day, and I'll see you in the next one.
See you, chump.